Stockholders' equity in the balance sheet represents the ownership portion of the corporation. Stockholders' equity can be split into two parts, paid-in capital and retained earnings. Paid-in capital represents amounts that the stockholders have contributed towards the corporation. Retained earnings represents the amounts that have been earned by profitable operations. As you all know, net income and dividends are part of retained earnings. Corporations also have two classes of stock. Most corporations have the basic form, which is a common stock, but some companies also issue what we call preferred stock. Let's first take a look at common stock. Common stock is a basic form of stock. This is what typically most companies have. Common stock is the stock that has the four basic rights of shareholders. If you remember, the four basic rights are the right to vote, the right to earn a dividend, the right to receive a proportionate share of assets in the event of liquidation, and the preemptive right. These shareholders benefit the most if the corporation succeeds. But these shareholders also take more of a risk because they are the last to get paid back in the event of a liquidation. Let's look at preferred stock. Preferred stockholders have advantages over common stockholders. If a dividend is declared, preferred stockholders receive their dividends first. Also, in the event of a liquidation, preferred stockholders receive any assets first before common stockholders are given any assets. Preferred stockholders earn a fixed dividend, so they will earn a percentage of whatever they have contributed. Let's compare issuing of stock and debt. This chart has three columns: common stock, preferred stock, long-term debt. Does a company have an obligation to repay the principal back to common stockholders? No, they do not. Common stockholders need not be paid back the principal. Same thing for the preferred stockholders. We do not need to pay back what they contributed. But for long-term debt, we do have to pay back the principal. It's a loan, so we have to pay back. How about dividends or interest? For common stock, dividends are not tax deductible. If we pay dividends, those are not tax deductible. Preferred stock, also the dividends are not tax deductible. However, interest is a tax deductible expense, and it is subtracted before calculating our net income before taxes. How about the obligation to pay dividends and interest? For common stock and preferred stock, we only pay dividends if the board of directors declare a dividend. If the board of directors don't declare a dividend, we do not have to pay dividends. Interest on long-term debt is a whole nother story. We are required to pay interest at fixed rates and fixed dates for long-term debt. If we do not do that, we are in default and they will initiate collection procedures. Before we move on to the accounting treatment of issuing stock, we need to talk about something called a par value. A par value is simply an arbitrary amount assigned to a share of stock. Companies usually set it very low, such as $1 or 25 cents, since most states don't allow companies to issue stock below par. Some companies have no par stock. We will learn how to account for stock with par value and no par stock in the next section.